Simon, you're a political economist. There's a lot of politics in economies at the moment. We're certainly talking about Europe in that respect. So perhaps my first question to you is the relationship between the two at the moment.
Well, you know, the report that you referred to really speaks about South Africa's relevance in the rest of Africa. And of course, South African companies looking at expanding into economies north of our border do face several constraints, several challenges in investing fluidly in markets which retain a very strong political and sometimes a fairly confused policy environment. But at the same time, we found a nimbleness, we found a dynamism amongst several South African companies in being able to approach these markets cognizant of the value that is attached to being having that first mover advantage and negotiating the challenges in a fairly pragmatic way.
How is Africa going to come out of this? We've talked quite a lot about South Africa and its exposure to European markets. The point has been made that nowhere really can come to the rescue. There are problems everywhere, some worse than others. Yet the Africa story has been one of growth for a long time. We in South Africa look at some of those African countries and we wish for the growth levels that they have. So Africa as a continent, as opposed to just South Africa, the exposure to this crisis, which we don't know which way it's going to go yet.
We don't, and several African economies are more vulnerable than others. So of course you can't speak homogeneously of Africa as being one single entity with one causal connection to Eurozone or United States economic downturn risk. Oil exporters or hydrocarbon exporters, Angola, Nigeria and others, will obviously their fates rise and fall to an extent on the price of oil. A price of $110 a barrel is fairly benign and it will offer support to those economies. As the price of oil declines, those economies start to suffer somewhat, whereas East Africa and other economies which are net oil importers find that the inflationary impact of lower oil prices does feed into slightly more positive sentiment on the growth. So there is no common answer. Of course, those economies, Nigeria, South Africa, of course, being the most, that are more integrated to global financial markets, are always going to be more vulnerable, and we see that playing out. One of the factors structurally which has taken place in sub-Saharan Africa, and this is where we find a lot of support that in the last 5 or 6 years, is the realignment to China, realignment to new poles of influence, as well as a significant improvement in domestic consumer fundamentals, which has provided some support to the corporate activity there.
Looking at different countries, and two of the ones that we talk about a lot on the program is Nigeria and Kenya. And from what you were saying, the West and the East, the oil exposure. Nigeria, of course, a lot of its revenues come from oil. So when they wake up in the morning, they certainly look at the oil price. What will the present range that it's trading in do to the Nigerian economy? It's been going between 96 and 102 for about a week. And of course, it came down quite sharply from the mid-120s.
I think Nigeria, as most economies, would have factored in a fairly lower oil price in their estimations, their budget expectations for the year. But generally speaking, of course, those fluctuations do have an impact. Nigeria has, over the course of the past 5 or 6 years, strongly diversified its economy. So while exports revenues are tremendously reliant on oil, the structure, at least the contribution to growth or contribution to GDP of the petroleum sector is fairly small. So you have a large agriculture, a growing services sector, manufacturing is of course nascent but growing. So Nigeria's economy has managed to withstand some of these fluctuations based on a diversification which has taken place particularly rapidly in the last 3 to 5 years or so, or thereabouts.
And what about Kenya in the European context? I mean, you think of their three revenue earners, tea, flowers, cut flowers, and tourism, for example. Now, each of these must be very sensitive to what's happening on the export destinations.
Of course, and that's traditionally been the case. So we saw Kenya suffering quite substantially in the immediate aftermath of the crisis. Particularly, you mentioned exports of horticultural goods, fresh cut roses, fresh cut flowers, etc. Those are likely to always see contracted demand when there is a negative sentiment. And the European Union still remains Kenya's largest export market for the majority of its agricultural produce. So there are tremendous strains there, and obviously the Kenyan economy is battling within a fairly prolonged reign of Eurozone stress.
We talked earlier to Nikki Weimar, the economist, and she showed two graphs which showed South Africa now, talking back to South Africa, within Africa, South Africa's exports to Europe have gone down from something like 35-40% of the total to 15 or 20 or 25, and the exports to China and the East have gone up by a similar margin. So the two graphs are crossing, as it were, and that must tell us that we have to start shifting our focus and not be obsessed with what's happening in Europe.
Yes and no. Overall, South Africa's total trade, around 38% of our total trade is with the European Union, the EU 27. So they still retain a very prominent position in our overall trade prospectus. Yes, we have shifted quite considerably to China, but you also need to consider the structure of that trade. So our trade with the European Union is far more balanced, far more diverse than our trade is with China. So our exports to China are virtually entirely made up of unprocessed commodities, and our imports from China are virtually all value-added manufactured goods of one form or another, or textiles. Our trade with the European Union over the course of the past decades has matured, has diversified, and as a result, we need to ensure that when we're shifting allegiance, or when we're shifting our priorities, we also focus on the way that we can restructure, or at least rebalance our trade with China and rebalance our trade with some of these rapidly rising emerging markets. And that, in light of the report that we've put out on trade with the rest of Africa, our assertion is that the rest of Africa becomes far more important to South Africa, given the fact that that's where a lot of our manufactured goods, our value-added goods, are increasingly competitive, and that long term is where we need to focus on to ensure the success or the longevity of our manufacturing and industrial sector.
Everyone's looking for signs. This crisis has been going on, the markets have been waiting and seeing, companies are sitting on a lot of cash. Every little piece of news is analysed. What are you looking for? What are the signals that you are looking for to take us out of this crisis, for better or worse?
I think we're in for the long haul, and obviously the Europe story is there's a long way to go on that. As you see some positive sentiment out of some countries, you find negative sentiment emerging out of others. The United States seem to have performed far better than we expected. But the three real areas that we consider now, obviously it's the United States and Eurozone, and we're looking increasingly at China from that global implications of China's soft landing or hard landing. We still factor in that China will manage its reduced growth fairly benignly. The government is on top of most of the shocks and most of the features which are exerting strain on the economy. But nevertheless, China, given the weaker external demand out of the Eurozone, given the shift which is taking place from export-led, investment-led growth to a more consumption or consumer-led growth, there is going to be a slowing of the Chinese economy. And African economies, as we mentioned earlier with South Africa, that have become increasingly aligned to China, need to be alive to the potential ramifications of that slowing down on their own growth. And at the moment, those lines of contagion are fairly minimal. Structurally, China and Africa are very well aligned, but obviously we can't be naive to think that China is going to continue to grow at the 8, 9, 10% given the global complications that we see.
That was Simon Freemantle, Senior Africa Political Economist at Standard Bank.